You're welcome back to my YouTube channel, guys. So in this video, I'm going to be teaching you the simplest technique to liquidity for you to recognize liquidity. However, my partner is going to be the one making the video because he understands so much about liquidity as well, okay? So he's going to be the one teaching in this video.
Okay, so hello everyone, welcome back to Synthetic Goddess channel. So it's quite a privilege being here today. So just like she said, she specifically mentioned that one of the things we are looking at is the simplest way to identify liquidity. Now, or the simplest way to approach liquidity. Now, there are a few things specifically I know, which I'll be sharing today. Now, the first thing we need to understand is structure. We need to understand first what the market is displaying. Are we actually bearish or are we actually bullish? So if we are bearish, simply means the market creating series of what? Lower lows, lower highs, lower lows. Okay. Now, and the next thing, likewise, in the approach of identifying liquidity, we likewise need to understand what we mean by internal and external liquidity. That is by types of liquidity and likewise its characteristics. But we're only going to be looking at the simplest as I see it. Now, simple, the first thing as I see it is what the market gives you a break of its structure, which is from this low. We're looking at it in terms of pattern, not just structures, not with candlesticks. So let's say the market gives us a break of structure from this low, right? Now, and we solely understand that this could be the 24-hour time frame. The 24-hour time frame. It is one thing specifically I like to look at. I want to address the higher time frame, which is time frames like the 24 hours, time frames like the 8 hours time frame. Now, on the 24 hours time frame, you want to check out the draws on liquidity. Now, what are these draws on liquidity? We have um, internal liquidity such as fair value gap, we have imbalance, right? We have price gaps. Now, these are certain things or simple liquidities that can actually be traced down to the higher time frame or up into the higher time frame. So the first thing as a trader you want to actually get is, are they fair value gap or is the liquidity, or sorry, is the imbalance on the 24-hour time frame? Now I'm going to be giving you a very simple example. Now, just like this analysis, if you check carefully, remember as I said, 24 hours, you want to totally understand structure, you want to understand if the order flow specifically is bearish. Now, see, the market extremely here is bearish. You can see what has been denoted here is a break of the structure. The next thing you've seen me mark is a POI, a possible POI once the market runs through this low and returns back here. Okay. Now, and you will also denote carefully that this is internal. That is, before the market breaks structure, it created structures inside before giving us the main break of the structure to identify that we are extremely bearish. Okay. Now, notice how the market gave us this gap, this space. Now, this space, which within this candle and this candle's high, okay, between this candle's low and this candle's high. You notice that what we have an imbalance, a fair value gap, right? This is identified as fair value gap. Now, I have broken structure. I am now telling you that what that later on in price, I want to see the market give me a little bit of distance, right, away from this break of the structure and return back. Now, we're not just returning back into this, into this point of interest that have been marked. We are looking forward back into this area of premium, which is supply, right, to take out this fair value gap. So you want to check out areas of fair value gaps. These are very important, very important. Okay, the higher time frame, the 24 hours. So I can fully tell okay, good. On the 24 hours later on in price, I would want to see the market back into a fair value gap. Now, another easy way to identify liquidity, remember, these are not just the only liquidity in the marketplace. Now, there are most times we've had a case scenario where the market had to give us what a high, give us a lower low, give us a high, come back, sweep this, and continue. Now, you see, this is liquidity on itself. You notice that what from this structure, the market did not really notice that from this structure, the market did not really mitigate into this point of interest. Now, leaving this high to be what to be very, very visible for the market to come read. This is an area where we have a whole lot of sellers, those who will be looking for sales, right, at the level of support. The market comes back to grab it. Now, in a liquidity such as this, we will need something to validate it. Now, take note, there are differences between the fact where the market creates a high, creates a low, then does something like this. Okay, notice this low has not been taken. There is one thing consistent about structure and liquidity. You must always see a reaction. Then what follows is a validation. Same thing likewise liquidity with liquidity. For a low or a weak low to be what? To be, or sorry, a low to be what? To be seen as liquidity, then there must be a validation. That validation comes by a break of the structure. I repeat, by a break of the structure. Now, what do I mean? The market specifically gives us a higher time frame structure. Okay? It gives us a higher time frame structure and probably gives us this high after. Now, for us to consider this as liquidity for the market to come back to take, we will need the market to take back this particular low, right? Breaking this low validates that this high is liquidity for the market to come back and read. So once the market breaks structure, we are breaking structure that we have validated that this will be seen as an area of liquidity. Now, once the market takes it out, the next thing you want to see as a trader is anticipation that the market should break structure. Now, take note of two things. The first break of the structure happened to validate that this is liquidity. The next break of the structure is to validate that this particular liquidity has been has been taken. Now, in a case scenario where the market creates a high, the market comes back to read it and fails to break structure, which is failing to break below this low. Now, when you see a case scenario where the market fails to do so and start returning back up, most of us tend to look at this as a break of structure, a change of character. No, it is not a change. The market hasn't changed any direction at all. The market only came back to sweep the high that absorbed the liquidity, so leaving this as a weak high. This became weak because the market created a high that swept liquidity and failed to validate it by breaking this low. So therefore, the market only came back to sweep a high that is so weak. So now once the market sweeps this high and breaks structure finally, it now validates that the market swept liquidity. There was not enough strength. Market came back to grab weakness and broke structure. So this validation validated that now this validation now validates that weak high has been swept, the proper liquidity has been swept. So I would want to believe that this is something you should understand. Then this is when we can now say that this is a low, a high, right? Where's the next or true lower low? Since the market has performed all of this structure, we can now say this is the true lower low, this is the true lower high, and break of structure, market break structure. So two simple things you need to take home with is 1, reaction, 2, validation, 3, take note of weaknesses in the market. That is weakness in terms of structure. Okay, try to identify weaknesses away from the normal structure, from the actual structure. If we can identify when a structure is weak and when we have a structure that is strong, then you're extremely fine. This helps you to validate simple ways of identifying liquidity. We have other forms. I've talked about fair value gap. I've talked about levels that needs to be taken, right? More like inducement or primary inducement. What validates it is a break of a structure. So going through what I've explained, you can go through this video again, and trust me, you will get everything explained properly. Wish you good luck and good trading.